The first thing I want you to understand is that a currency system does not break in one dramatic moment. It usually changes quietly. It changes through one agreement, then one exception, then one country deciding it wants more flexibility, then another country asking whether the old rules still serve its interests, then one reserve manager reduces exposure, then one oil contract is settled in a different currency, then one central bank buys more gold. By the time most people notice, the system has already been moving for years. That is why the news about the United Arab Emirates leaving OPEC matters. Most people will talk about the Middle East. They will talk about oil production. They will talk about geopolitics. They will talk about whether prices go up or down. But I want to look at the deeper machine. I want to look at the dollar, because when an oil-producing country that has been part of the old structure for decades decides to step away, the question is not only what happens to oil. The bigger question is what happens to the system that made the dollar so powerful. That system is called the petrodollar system. And if you understand it, you understand a large part of why the United States has been able to finance itself the way it has for the last half-century. You also understand why gold has been rising. You understand why central banks have been changing reserves. You understand why China wants oil priced in yuan. You understand why countries became more nervous after the Russia sanctions. You understand why ordinary Americans feel the value of their dollars quietly falling even when the number printed on the bill does not change. Start with the simple question, what is a $100 bill worth? The obvious answer is $100, but that answer does not explain anything. The deeper question is what $100 can buy, because $100 today is not the same as $100 5 years ago. It is certainly not the same as $100 50 years ago. The paper can look the same, the number can be the same, the buying power can be completely different. That is the difference between nominal money and real money. Nominal money is the number. Real money is what the number buys. If the number stays the same, but the cost of food, gas, housing, insurance, medical care, education, and basic life rises, then the money has lost power. This is one of the most important principles in economics. You can print currency. You cannot print real wealth. Real wealth comes from productive capacity, resources, labor, technology, energy, land, businesses, and trust. Currency is a claim on those things. If you create more claims without creating more real wealth, each claim eventually buys less. That is how debasement works. Before 1971, the United States dollar was linked to gold under the Bretton Woods system. The details are complex, but the basic idea was that the dollar had a connection to physical gold. Foreign governments could convert dollars into gold at a fixed price. That connection imposed discipline. If the United States wanted to spend far more than it had, it could not simply print infinite dollars without consequences, because other countries could demand gold. Gold was the constraint. You can create paper claims quickly. You cannot create gold quickly. That changed on the 15th of August 1971, when President Nixon suspended the convertibility of the dollar into gold. The word used was temporary, but temporary has lasted more than 50 years. That was a major transition. The dollar moved from a gold-linked system to a fiat system. Fiat currency is backed not by gold, but by government credibility, tax power, legal structure, military power, economic strength, and the belief that other people will accept it. That does not make fiat currency worthless. It means trust becomes the anchor. If people trust the government, the institutions, the economy, the military, the legal system, and the liquidity of the markets, the fiat currency can remain powerful for a long time. The dollar did remain powerful. But after gold was removed, the system needed another anchor. That anchor became oil in the 1970s. After the oil shock, the United States made a strategic arrangement with Saudi Arabia. Saudi Arabia, one of the most important oil producers in the world, would price oil in dollars and recycle oil profits into US dollar assets, especially Treasury securities. In exchange, the United States would provide weapons, military protection, and strategic support. That was the core bargain. Oil would be sold in dollars, oil profits would flow back into dollar assets, the United States would support the security of the Gulf. This created a new kind of backing for the dollar, not gold backing, oil demand backing. Every country needed oil. If oil had to be bought in dollars, then every country needed dollars. Japan needed dollars, Germany needed dollars, India needed dollars, China needed dollars, emerging markets needed dollars, energy importers needed dollars. That created structural demand for the dollar. And because oil exporters received dollars, they accumulated dollar surpluses. Those surpluses often moved into U.S. financial markets and treasury bonds. That created structural demand for U.S. government debt. This is the petrodollar machine. The world needed oil, oil needed dollars. Oil exporters earned dollars. Those dollars were recycled into U.S. debt. The United States could borrow more easily. The dollar stayed dominant. That machine helped support American power for decades. Most people did not see it because it operated in the background. They did not need to know about the petrodollar to buy groceries. They did not need to understand Treasury recycling to receive a paycheck. They did not need to understand reserve currency status to use a debit card. But the background machine mattered. It helped keep the dollar strong. It helped keep borrowing costs lower than they otherwise might have been. It helped the United States finance deficits. It helped make the dollar the operating currency of the world. That is why changes to the petrodollar system matter. Now, the system did not begin cracking only because of one decision by the UAE. The cracks have been forming for years. One major accelerant was the pandemic. In 2020, the United States government spent enormous amounts of money, stimulus checks, unemployment support, PPP loans, business bailouts, emergency programs, liquidity facilities, support everywhere. Some of that was necessary to prevent a deeper collapse. But necessary does not mean costless. The government did not already have all that money sitting in a vault. It borrowed, and the Federal Reserve helped create liquidity. Trillions of dollars moved into the system quickly. People around the world watched that happen. They understood the basic problem. If the United States can print enormous amounts of dollars, what happens to the value of the dollars already held by foreign central banks, governments, businesses, and savers? This is the reserve currency problem. The dollar is the world's main reserve currency that gives the United States extraordinary advantages. But it also means other countries hold large amounts of dollar assets. When the United States prints aggressively, those countries bear part of the cost through purchasing power risk. They begin to ask whether they want so much of their wealth tied to decisions made in Washington. That question became more urgent after the Russia-Ukraine war. After Russia invaded Ukraine, the United States and its allies froze and restricted access to Russian dollar and euro assets. From one perspective, this was a geopolitical response to aggression. From another perspective, every other country in the world learned a lesson. Reserves are not just money. Reserves are political claims inside someone else's system. If your assets can be frozen because the issuer of the reserve currency disapproves of your actions, then those assets carry political risk. You may agree with the policy against Russia. That is not the point. The point is that central banks around the world saw that dollar reserves could become unusable under certain conditions. If you are a country that may one day conflict with Washington, you must ask a simple question: what can I own that cannot be frozen by another government? That question leads to gold. It also leads to alternative payment systems, local currency settlement, bilateral trade agreements, and reserve diversification. This is why de-dollarization is not just ideology. It is risk management. Countries are not necessarily saying the dollar will collapse tomorrow. They are saying we do not want all our reserves dependent on one political system. That is a very different and more serious statement. The numbers show the direction. In 2001, roughly 72% of global foreign exchange reserves were held in US dollars. By the end of 2025, according to the source, that share had fallen to about 56%. That does not mean the dollar lost reserve status. It means the concentration declined. And when reserve concentration declines in a system this large, the flows matter. A fall from 72% to 56% does not happen because one person is worried. It reflects a broad and gradual rethinking by governments and institutions around the world. The dollar remains dominant, but dominance is different from monopoly. The monopoly is weakening. That is the key. Now, China plays a major role in this shift. China has been trying to strengthen its own currency and reduce dependence on the dollar system. It has built oil futures priced in yuan. It has encouraged trade settlement in its own currency. It has worked with countries that produce and consume energy. It has bought oil from countries like Iran and Venezuela, often in ways that reduce reliance on the dollar system. This matters because China is one of the largest energy buyers in the world. If a major oil buyer wants to pay in yuan and a major oil producer is willing to accept yuan, then the dollar-only oil system begins to lose exclusivity. For decades, the petrodollar system meant that oil trade reinforced dollar demand. If large enough portions of oil trade move into other currencies, the automatic demand for dollars weakens. Again, this is not an overnight collapse. It is a gradual erosion of the dollar's special role. The source points to 2023. When Saudi Arabia began selling oil to China in Chinese yuan. This was symbolically important because Saudi Arabia was the same country that helped create the petrodollar system with the United States. When the country at the center of the original bargain begins accepting another currency for oil trade with China, the signal matters. It tells the world that the old rule is no longer absolute. Now add the UAE. The UAE has been a vocal participant in de-dollarization discussions and has worked with countries like India to settle trade in local currencies rather than always using the US dollar. If the UAE leaves OPEC after decades inside that system, the question becomes what kind of independence it now wants. Does it want more freedom over production, more freedom over customers, more freedom over currency settlement, more flexibility in oil policy, more alignment with Asian demand? We do not know all the details yet, but the direction is clear. A major Gulf oil producer wants more independence, and independence in oil increasingly connects to independence from dollar-only settlement. This is why the dollar story is embedded inside the oil story. The Middle East is not simply a region of energy supply. It is part of the architecture that supported the dollar after gold was removed. When that architecture shifts, the effects can reach American consumers, the U.S. stock market, the Treasury market, the global economy, and the price of gold. Now, let me be very clear. The United States dollar is not going to collapse tomorrow. The United States economy is not going to collapse tomorrow because of this one announcement. Extreme predictions are usually not useful. The United States still has the deepest capital markets in the world. It still has the largest and most liquid treasury market. It still has enormous military power. It still has extraordinary technology companies. It still has the rule of law relative to many alternatives. It still has a network effect built over many decades. The dollar remains central, but the direction of travel matters. A reserve currency does not need to collapse for investors to be affected. It only needs to lose share, lose trust at the margin, or force the United States to finance itself under less favorable conditions. If fewer foreign actors automatically recycle dollar surpluses into treasuries, the United States may eventually face higher borrowing costs, more reliance on domestic buyers, more pressure on the Federal Reserve, or more inflationary financing. Those are not small issues. They affect mortgage rates, they affect government interest expense, they affect asset valuations, they affect taxes, they affect inflation, they affect the purchasing power of wages, they affect the real value of savings. That is why ordinary people should care. This is not an academic currency debate. It is about the value of the money people work for, save, and spend. If the dollar weakens over time, your paycheck may buy less, your savings may lose real value, your cost of living may rise, your investments may need to be positioned differently. The financial system can change without announcing itself clearly to the public. That is why you need to study the mechanics before you feel the effects. Now, if the dollar system is weakening at the edges, the next question is how investors should think. The first asset to understand is gold. Gold has risen strongly, and that rise did not happen by accident. There are two major forces behind gold. The first is concern about inflation and dollar debasement. When people believe the government is creating too much currency, they often turn toward gold because gold cannot be printed. Gold is not someone else's liability. It is not a promise from a government. It does not depend on a central bank's credibility. It sits outside the fiat system. That does not mean gold is perfect. It produces no cash flow. It pays no dividend. It does not innovate. It does not grow earnings. It can sit in a drawer and do nothing, but sometimes doing nothing is exactly the point. Gold's role is not to produce. Gold's role is to preserve value when trust in paper claims declines. The second force behind gold is central bank buying. Central banks around the world have been buying gold because they want to strengthen and diversify their reserves. Countries like China, Turkey, and others have increased gold holdings. That is not random. They are managing reserve risk. If dollar assets can be frozen, if dollars can be debased, if U.S. deficits are rising, and if the world is fragmenting into geopolitical blocks, then gold becomes more attractive as neutral reserve collateral. Gold has no nationality. Gold has no issuer. Gold has no counterparty. Gold cannot be sanctioned in the same way a bank deposit can be sanctioned if it is held outside your control. This is why central bank gold buying matters so much. Retail investors can get emotional about gold. Central banks are less emotional. They are looking at reserve strategy, political risk, debasement risk, and diversification. When reserve managers buy gold, investors should ask what they are trying to protect against. But gold must be understood properly. I do not think of gold as a normal investment. A normal investment should produce value. A company earns profits. A rental property collects rent. A bond pays interest. A farm produces crops. A business creates cash flow. Gold does not do those things. Gold is better understood as hard money or monetary insurance. It protects against certain risks. It can hedge the dollar. It can hedge monetary debasement. It can hedge geopolitical fragmentation. It can hedge distrust in paper claims. That is its role. It is not an all-weather magic asset. Gold can fall. After the 2008 financial crisis, gold rose strongly because the government printed and stimulated aggressively. Then, when fears of collapse faded around 2012, gold prices fell and stayed weak for years. That is what happens when the fear driving gold demand recedes. Gold goes up when concerns about the dollar rise. Gold can fall when those concerns decline. So the right way to think about gold is not, gold always goes up. The right way is, gold is useful when trust in currency, credit, and fiscal discipline is under pressure. That is the environment we must evaluate if dollarization, deficits, inflation, sanctions, risk, and central bank diversification continue. Gold can remain relevant. If dollar confidence improves and real rates remain high, gold may face pressure. That is the balanced view. If someone does not want physical gold, there are ETFs that give exposure to gold, such as GLD, that can be easier to buy and sell, though it is not the same as holding the metal directly. Physical gold has no fund structure risk, but it has storage, insurance, security, and liquidity considerations. An ETF is convenient, but it adds custodian and market structure considerations. Each form has trade-offs. The principle is to know the role before choosing the vehicle. The second investment area is international diversification. If the world is moving away from a dollar-centered system at the margin, then investors may want some exposure outside the United States. Not because America is finished, not because US assets should be abandoned, but because concentration in one country, one currency, and one market can become a risk. International investing adds diversification. It can provide exposure to countries whose currencies, economies, and markets may benefit if capital flows become more multipolar. But international investing also carries higher risk, currency risk, political risk, accounting risk, liquidity risk, governance risk, regulatory risk, geopolitical risk. Emerging markets can grow faster, but they can also be more volatile. Developed international markets may be more stable, but they may grow more slowly. Country-specific funds can offer targeted exposure, but they increase concentration risk, so international investing should be approached with clarity. Broad international funds can provide global exposure. Developed market funds can target larger, more established economies outside the United States. Emerging market funds can target faster, growing but riskier economies. Country-specific funds can target places like China, India, Germany, or others. There is no single correct answer. The principle is diversification. If the dollar's monopoly weakens, the rest of the world may not remain passive. Some economies may attempt to strengthen their currencies, deepen their capital markets, and attract investment. That can create opportunities, but the risks must be understood. The third investment area is energy, because this entire discussion is connected to oil. Energy becomes important. If the petrodollar system weakens, if oil trade becomes more fragmented, if geopolitical tensions rise, and if the United States wants to become more energy independent, then domestic energy companies may benefit. Energy is not only a commodity sector, it is a national security sector. Oil powers transport, agriculture, military logistics, manufacturing, plastics, aviation, shipping, and much of the real economy. When oil becomes geopolitically sensitive, domestic production and energy independence become more valuable. Investors can get exposure through energy companies such as large U.S. oil producers and integrated energy firms, or through sector ETFs like XLE, but energy is cyclical. Oil prices can fall, political policy can change, supply can rise, demand can weaken during recessions. Energy companies can be very profitable in one environment and under pressure in another. So again, the point is not to blindly buy energy. The point is to understand why energy might become more important in a world where the old oil dollar system is less stable. The fourth area is defense. This one can be morally uncomfortable for some investors, and that is legitimate. People must know their own values. But from a financial standpoint, geopolitical tension often leads to higher defense spending. If the Middle East becomes more unstable, if great power competition intensifies, if dollarization is tied to geopolitical fragmentation, governments spend more on military equipment, aerospace systems, missile defense, naval power, cybersecurity, surveillance, and defense technology that can benefit defense and aerospace companies. Funds like EDA can give exposure to that sector. But investors should understand what they own. Defense companies depend heavily on government contracts, procurement cycles, politics, budgets, and execution. They can benefit from geopolitical tension, but they are not without risk. The moral question also matters. An investment must make financial sense, legal sense, and personal moral sense. If a defense investment violates your values, you do not need to own it. There are many ways to build wealth, but if you are analyzing how Wall Street thinks, then defense belongs in the conversation when geopolitical risk rises. The fifth area is still the United States stock market. This is very important. A weakening petrodollar monopoly does not mean you abandon America. The United States remains one of the greatest economic opportunity engines in the world. It has dominant technology companies, deep capital markets, entrepreneurial energy, strong universities, powerful consumer markets, and many of the largest companies on earth. The dollar can lose share and U.S. businesses can still compound. Both can be true. This is where people often make mistakes. They hear a dollar risk argument and assume the only response is to leave us assets entirely. That is too simplistic. The U.S. economy is not collapsing tomorrow. The U.S. stock market still contains extraordinary companies. Broad exposure to the American economy through funds that track the total U.S. market or the S&P 500 can still make sense for long-term investors. The key is not to panic sell when markets fall or blindly buy because markets are at highs. The key is to understand that long-term investing means owning productive assets through cycles. An S&P 500 fund like SPY gives exposure to 500 large U.S. companies. It is not a bet on one company, it is broad exposure to American corporate power. If the dollar is gradually debased, high-quality companies with pricing power may adjust over time. They can raise prices, grow earnings, buy back shares, pay dividends, and continue operating in nominal dollars that may become more abundant. That is one reason stocks can protect purchasing power better than cash over long periods. Not perfectly, not every year, not without drawdowns. But over time, ownership of productive assets can help protect against currency debasement. This is why cash alone is dangerous in an inflationary world. Cash feels safe because the number does not fluctuate much, but the real value can decline quietly. Stocks fluctuate visibly. Cash loses purchasing power invisibly. You need to understand both risks. Now, I want to put the whole system together. Before 1971, the dollar had a gold anchor. After 1971, the dollar became fiat. After 1974, the petrodollar system created a new anchor through oil demand and treasury recycling. For decades, the world needed dollars because oil needed dollars. Oil producers earned dollars and recycled them into U.S. debt. That helped keep the dollar strong and helped the United States finance itself. After the pandemic, the United States printed and borrowed aggressively. Foreign governments began questioning the long-term value of dollar reserves. After Russia's reserves were frozen. Political risk became obvious. China pushed for oil settlement in yuan. Saudi Arabia began accepting yuan in certain oil deals with China. The UAE has been working with countries like India on non-dollar settlement and is now stepping away from OPEC. Global dollar reserves have fallen meaningfully over time. Central banks have been buying gold. These facts fit together. They do not prove the dollar ends tomorrow. They show that the old system is becoming less absolute. That is the key insight. The petrodollar system is not a light switch, it is a network. Networks weaken gradually at first. Then, if trust deteriorates enough, change can accelerate. The investor must pay attention before acceleration becomes obvious. Now, what should ordinary investors not do? Do not panic. Panic is almost always expensive. Do not sell everything because of one headline. Do not assume gold is guaranteed to rise forever. Do not assume international markets are automatically better than U.S. markets. Do not assume energy stocks always benefit from oil conflict. Do not assume defense spending means every defense stock is a good buy. Do not assume the dollar is dead. Do not assume the dollar is invincible either. Both extremes are dangerous. The better approach is to think in probabilities and build a diversified system. You can own U.S. productive assets, you can own some international exposure, you can own some gold or gold-related exposure as a hedge, you can own energy exposure if it fits your thesis, you can own defense exposure if it fits your values and analysis. You can hold cash for liquidity while understanding cash has inflation risk. You can avoid over-concentration in any one narrative, that is resilience. Resilience matters more than ideology. The world is changing. But no one knows the exact path. The dollar may remain dominant for decades while losing share gradually. Gold may rise but experience sharp corrections. International markets may benefit but remain volatile. Energy may rise during geopolitical stress but fall in recessions. Defense may receive more spending but depend on politics. U.S. stocks may continue compounding despite dollar concerns. A good portfolio must be able to live with uncertainty. That is why I think in systems, The system tells us that when trust in a fiat reserve currency weakens, investors search for alternatives. Some move into gold, some move into other currencies, some move into real assets, some move into equities, some move into commodities, some move into international markets. Capital does not disappear, it moves. Your job is to understand where it may move and why. Now, there is a deeper lesson about government spending. When a government can print money, people often ask why taxes are necessary. The answer is that taxes are not only about collecting money, taxes support demand for the currency because obligations must be paid in that currency. Taxes also help reduce excess money in circulation. Without taxation and borrowing discipline, money creation can become inflationary. If the government creates dollars faster than the economy creates real wealth, the dollar's purchasing power declines. This is why inflation is not simply rising prices. It is the reduced value of the currency relative to goods and services. And if the world begins to demand fewer dollars for oil and reserves, then the United States loses part of the external demand that helped absorb dollar creation. That makes fiscal discipline more important. But fiscal discipline is politically hard. People like spending, people dislike tax increases. Politicians prefer delay. Central banks prefer to avoid depression. That means large debt systems often rely on inflation, refinancing, and financial repression to manage burdens. This is why gold and real assets become more interesting in late-stage debt cycles. They are responses to incentives. Now, the role of oil should not be underestimated. Oil is not just another commodity. It is embedded in the functioning of the global economy. It powers the movement of goods. It affects food production. It affects military capacity. It affects transportation. It affects inflation. It affects trade balances. It affects the strategic relationship between producers and consumers. That is why the currency of oil trade matters. If oil moves away from dollar-only settlement, the reserve system changes. Not instantly, but meaningfully. And because the petrodollar helped create demand for treasuries, changes in oil settlement can ultimately connect to U.S. government financing. This is the chain most people miss. UAE leaves OPEC. People talk about oil politics, but the deeper issue is whether oil producers become less bound to the old dollar-centered system. If they do, then dollar demand may weaken at the margin. If dollar demand weakens, treasury demand may weaken at the margin. If treasury demand weakens while U.S. debt issuance remains high, yields may need to rise or the Fed may need to intervene more. If yields rise, the government's interest burden grows. If the Fed intervenes, debasement risk rises. If debasement risk rises, gold and other real assets may benefit. That is the systemic chain. You do not have to believe it happens tomorrow to understand why it matters. Now, there is another layer involving China. China wants more influence over global trade settlement because a country whose currency is used in trade gains strategic power. If oil can be bought in yuan, China reduces dependence on dollars. If producers accept yuan, China strengthens the international role of its currency. If yuan oil futures become more credible, the oil market becomes less dollar exclusive, but there are limits. China has capital controls. Its financial markets are not as open as U.S. markets. Global investors do not trust Chinese institutions to the same degree they trust dollar liquidity. The yuan cannot simply replace the dollar overnight. That is why de-dollarization is not the same as yuan dominance. It is more likely a move toward fragmentation, more yuan settlement in some trades, more local currency agreements, more gold reserves, more regional payment systems, more diversified reserve baskets. The dollar remains important but less absolute. Fragmentation is harder to manage than a single dominant system. It creates complexity, volatility, and new opportunities. Now, what should a long-term investor do with that complexity? First, stay informed. Second, avoid binary predictions. Third, build real purchasing power. Fourth, diversify across assets that respond differently to currency risk. Fifth, keep liquidity. Sixth, own productive assets. Seventh, do not let fear drive over-concentration in gold or any one hedge. Gold can protect against certain risks, but productive businesses build wealth over time. International exposure can diversify, but the United States still matters. Energy and defense can benefit from geopolitical stress, but they are cyclical and political. A balanced investor understands roles. This is the important word. Role. What role does gold play? Hedge against dollar distrust. What role do international stocks play? Diversification beyond U.S. currency and market concentration. What role does energy play? Exposure to oil, inflation, and geopolitical energy security. What role does defense play? Exposure to government spending tied to geopolitical risk. What role do stocks play? Ownership of productive businesses and long-term compounding. What role does cash play? Liquidity and optionality despite inflation risk. If every asset has a clear role, the portfolio becomes a system. If assets are bought because of fear or excitement, the portfolio becomes chaos. Now let me speak directly to the American worker. If you earn dollars, save dollars, and spend dollars, this matters to you. Not because you should panic about the dollar, because you should understand that the value of your labor is stored in a currency whose purchasing power changes. If the dollar loses real value, your wages need to rise just to keep you even. If your savings earn less than inflation, you are moving backward. If your retirement plan assumes stable purchasing power, it may be too optimistic. If your portfolio is all cash, you may feel safe while losing wealth slowly. If your investments are all in one country and one currency, you may be concentrated without realizing it. This is why financial education matters. The goal is not to predict every geopolitical event. The goal is to position your life so you are not destroyed by monetary changes you did not understand. Now, I also want to avoid a common mistake. People often hear de-dollarization and immediately think of collapse. Collapse is dramatic. It gets attention, it makes good headlines, but gradual erosion is more likely and more dangerous because people ignore it. If the dollar loses 2% of purchasing power every year, people adapt slowly. If it loses more during inflationary periods, people complain but keep working. If foreign reserves slowly diversify, the headlines are scattered. If oil contracts gradually move into other currencies, each deal looks small. If central banks quietly buy gold, most people do not notice. But over a decade or two, the system changes. That is how empires often adjust, not all at once. Through marginal shifts that compound, the investor should pay attention to the compounding of small shifts. Now, let us return to the UAE. The UAE leaving OPEC is important not only because it may affect production policy, but because it signals a desire for more independence. In a world where oil producers seek independence, they may also seek independence from old settlement systems, old security dependencies, and old reserve practices. If more oil producers choose flexibility, the petrodollar becomes less rigid. If the petrodollar becomes less rigid, the dollar loses part of its automatic demand. If the dollar loses automatic demand, the United States must rely more on the inherent attractiveness of its markets and the credibility of its policies. That means fiscal discipline and institutional trust become more important. If those weaken, the adjustment can be painful. This is why U.S. deficits matter. The United States cannot assume that foreign demand for its debt is infinite. If it keeps issuing debt while some foreign reserve managers diversify, the cost of borrowing may eventually change. That cost does not stay in Washington. It spreads into mortgage rates, business loans, taxes, inflation, and asset prices. This is why macro is personal. Now, what is the final investment principle? Do not bet everything on one future. If the dollar remains dominant and U.S. stocks keep leading, you want exposure to U.S. equities. If the dollar loses share and gold rises, you want some hedge exposure. If international markets benefit from multipolar growth, you want some global diversification. If energy security becomes more important, you may want energy exposure. If geopolitical tensions rise, defense exposure may benefit. If it fits your values, if inflation remains sticky, cash alone will not protect you. If markets crash, cash becomes valuable. The portfolio must balance these competing realities. That is what serious investing is. Not shouting that the dollar is dead, not insisting the dollar can never weaken, not buying one asset because of one headline. Building a system that can survive a range of outcomes. Now let us close the loop. The dollar began as a claim anchored to gold. Then it became fiat. Then the petrodollar system gave it a new global anchor through oil. That system worked for decades because the world needed dollars to buy oil, and oil exporters recycled dollars into U.S. debt. After the pandemic, massive money creation raised doubts. After Russia's reserves were frozen, political risk became obvious. China pushed for oil trade in yuan. Saudi Arabia accepted yuan in certain oil deals. The UAE has supported non-dollar settlement and is now leaving OPEC. Global dollar reserves have fallen meaningfully over time. Central banks are buying gold. These are not random events. They are signs that the world is slowly reducing dependence on the dollar system. The dollar is not dead. But the old petrodollar monopoly is weakening. That matters. And if you understand it early, you can respond calmly instead of emotionally. Gold as a hedge. International exposure as diversification. Energy as a geopolitical and inflation. Sensitive sector defense as a government spending beneficiary in a tense world. U.S. equities as long-term ownership of productive businesses. Cash as liquidity. No single piece solves everything together. They create resilience. That is how I would think about this moment, not with fear, not with certainty, with principles. Because when money systems change, the people who understand the machine usually have more choices than the people who only notice after prices have already moved. The petrodollar system is not ending in one day, but it is changing, and changes at the foundation of the global monetary system should always be respected.